Welcome back to Investing Talk podcast. Today, we're zeroing in on one of the really closely watched reports this season. We're focusing on American Express and its upcoming third quarter 2025 earnings. This discussion should really help you understand the pulse of the affluent consumer right now. And hey, please remember to subscribe, like, and comment below. Also, definitely let us know if there's a specific company you want us to look into in a future analysis. Just drop it in the comments.
Yeah, this one's important. It's crucial, really, for anyone tracking the broader economy. American Express, it acts like a pretty direct barometer. It tells us two key things at once: how healthy that premium cardholder segment is and where we stand in the whole credit cycle for payment processors.
Okay, let's unpack this right away then. We're talking Q3, so that's the July through September period. Give us the essential timeline and the main numbers everyone's watching.
Right. So the date you need is October 17th, 2025. The release drops at 8:30 a.m. Eastern Time. As for the numbers, the consensus forecast is targeting $16.64 billion in revenue.
64 billion, and what kind of growth does that represent?
If they hit that, it means a pretty respectable 5.1% growth compared to the same quarter last year, year over year.
Okay. And what about the crucial bottom line? Earnings per share.
Yeah, EPS, analysts are mostly clustered around $3.08 JAP. That's up about 4.4% from Q3 last year.
Okay, 4.4%. Modest.
But here's where it gets a little interesting, something we picked up. There's this unofficial whisper number floating around.
Oh, and what's that saying?
It's actually a bit higher, sitting at $3.13 per share.
Ah, so 5 cents higher.
Exactly. That little difference, it suggests that maybe the smart money thinks there's potential for an upside surprise, maybe stronger summer travel kicking in, that kind of thing.
Right, that makes sense. And this potential optimism, it has to be viewed against what the company itself is guided for, doesn't it?
Yeah.
They haven't changed their tune on the full year.
Precisely. You got it. They reiterated their full year 2025 guidance back in Q2. They're still aiming for 7% to 9% revenue growth for the whole year, and EPS between $12 and $12.65.
So management's basically projecting confidence, even with all the economic chatter out there.
Yeah, they're signaling they believe they can execute.
Okay, now here's where it gets, like you said, really interesting. American Express, they seem to have this habit, right, of beating analysts' expectations. How does their recent track record set the stage?
Well, yeah, AXP is known for being a consistent outperformer.
Yeah.
They've actually beaten the EPS estimates in the last 4 quarters straight. For instance, Q2 2025, they beat by 8 cents. Q4 last year, 2024, they beat by 12 cents. They generally know how to manage expectations and deliver.
Okay, but hang on. If they consistently beat, yet the stock reaction after earnings is usually, well, moderate, right? You mentioned plus 1.7% for Q2, plus 2.9% for Q4.
Yeah, that's generally true. The only recent negative was Q3 last year, down about 2.3%.
So doesn't that suggest the market is already pricing in a beat? Like, the real expectation is actually higher than the official consensus number. Maybe a beat is just meeting the real bar.
That's a really sharp point, yeah. It highlights that the quality of the beat matters immensely. The moderate stock moves probably mean that, yes, a high-quality performance is largely expected, already baked into the price. Perfection is almost demanded here.
Limits the surprise upside, then.
Exactly. It limits that explosive potential. However, we have seen some positive momentum building into this report. Over the last, say, 3 months, analysts have been nudging their expectations up, just modestly. EPS estimates are up about 1.2%, revenue up 0.6% in that time.
Why is that subtle upward creep significant right now? What's driving that quiet optimism, do you think?
Well, it suggests that the incoming data analysts track things like transaction volumes, maybe early credit signals. They didn't seem to fall off a cliff as the quarter closed. It shows maybe some conviction that the company's strategies, especially around those premium cards, are holding up despite the macro worries.
Okay, so for you, the listener, tracking this business, we need to know what specific operational things actually drive the top and bottom lines. Beyond the headlines, what should we be focusing on?
Right, let's break it down. There are 3 core drivers to watch closely. First is spending momentum. We saw their total billed business hit $394 billion in Q2. That was up 7% year over year.
And Q3 typically gets a boost from summer travel, right? Yeah. And business spending.
Exactly. Summer travel, SME spending, small and medium enterprises. The key question is, can they maintain that 7% growth or maybe even improve on it? That reflects premium consumer confidence.
Okay, spending momentum. What's number 2? Maybe the most talked about move this quarter.
Absolutely. The big one, pricing power. Specifically, that huge Platinum Card annual fee hike they announced in September.
Right, that jumped from $695 to what, $895?
$895, a massive jump, nearly 28%. It's a serious test of their pricing power. And it happened during the quarter we're talking about. It really underscores their focus on maximizing value from that affluent customer base. We need to see if that flows through quickly.
Wow, almost $900 a year. Is there any sense yet whether cardholders pushed back? Any signs of attrition from that, or are affluent folks just shrugging it off?
It seems AXP is betting heavily that their whole benefits package, the ecosystem around the card, is sticky enough to justify it. If they report continued growth in, say, card member engagement metrics alongside this, it validates that strategy.
So connecting the dots, the really critical metric becomes card member ARPU, average revenue per card member.
Precisely. Average revenue per unit, or per card member here, it's vital because if ARPU is climbing significantly...
It means the fee hike is working.
Exactly.
Yeah.
It means they're pulling way more value per user, which then gives them a direct, powerful buffer against rising costs elsewhere.
Okay, which brings us neatly to the third factor, the big risk everyone's watching across the whole payment space right now, credit quality. How's Amex handling that normalization?
Yeah, this is crucial. We have to watch the provision for credit losses very closely. See, when we talk about credit normalization, it just means defaults and delinquencies are starting to tick back up towards more normal historical levels, away from those artificially low rates we saw during the pandemic stimulus years.
And that means higher expenses for Amex, setting money aside for potential losses.
That's the expense, yes. Now, they've done a good job so far preserving what they called an exceptional 2% net write-off rate as of August. However, that provision for credit losses, the money set aside, is already up in Q2, $1.5 billion. That was higher year over year.
So the core challenges are the huge profits from that platinum fee hike enough to cover the rising tide of defaults across their wider customer base?
That's the balancing act, perfectly stated. Is the provision stabilizing or is it accelerating faster than revenue? That's the key tension.
Right, this tension between premium pricing power and normalizing credit risk. Did they launch anything else new this quarter to maybe boost network usage, help the revenue side?
They did. There was that Stripe partnership announced back in July. That's more of a long-term catalyst, though.
What's the goal there?
It's designed to get more U.S. merchants, especially smaller online businesses, to accept American Express cards. The thinking is wider acceptance means more places to use the card, which should, eventually drive up that total billed business number, add density.
Got it. So pulling this all together, what does it mean for how people are positioned going into the report? Are the experts aligned or are there different takes?
Oh, definitely different takes. It's sort of a classic split depending on which driver an analyst emphasizes more. You've got JP Morgan, for example. They reiterated an overweight rating, target $245. They're focused on those strong premium consumer trends. Betting the fee hike really pays off.
Okay, that's the bullish view.
Then you have, say, Goldman Sachs. They maintained a neutral stance. They expect, and I quote, stable net interest margin and manageable credit.
So more cautious, betting on stability, maybe, but worried about that credit provisioning cost offsetting the gains.
Exactly. They see the headwinds balancing things out more. Stability, not acceleration.
Given that split view, what kind of immediate stock price move is the market actually bracing for? What are the options telling us?
Right, the options market. It's currently implying an expected move of about plus or minus 4.0% right after the earnings hit.
So roughly $8.40 a share, give or take.
Yeah, around that. It suggests the implied volatility premium is, well, noticeable, but maybe not extreme. Kind of lines up with those moderate historical reactions we talked about.
Okay, let's quickly game out the scenarios presented. What would drive a more optimistic, bullish outcome?
The bull case, which maybe has like a 20% probability assigned, that gets triggered if international spending or maybe corporate spending comes in surprisingly strong. And crucially, if credit costs remain stable or even slow down, the ultimate kicker would be if they actually raise their full-year guidance, especially if they talk about NIM expanding. Strong ARPU is key there.
Makes sense. And the flip side. What triggers that less likely but still possible bearish scenario?
The bear case, maybe a 15% probability. That happens if SME spending, small business, or maybe travel spending really lags expectations. That hits the core business narrative. And critically, if that provision for credit losses number comes in significantly higher than expected, that would validate the fear that credit normalization is happening too fast, squeezing margins.
Okay. So, if you, the listener, are looking at the press release on October 17th, look past the headline EPS beat or miss and focus on the relationship between which two specific things again.
It really boils down to the interplay between those two pillars, card member engagement RPU, that shows how much they're making from premium users, and the provision for credit losses that shows the cost of managing risk across the board. The tug-of-war between those two really dictates the profitability story right now. So overall, the general leaning seems to be, I'd say, neutral to maybe modestly bullish going into the print. You've got those positive estimate revisions. The premium consumer seems resilient. But the big but is the uncertainty around how fast credit normalizes and how healthy that SME segment really is. That's the main risk hanging out there.
Yeah, it feels like American Express's momentum right now is really anchored to those strong premium card economics. That's their offense and defense. So here's a final thought for you to consider. Given they just showed serious pricing power with that massive platinum fee hike, how long can they sustain that high-end demand if the broader economy keeps slowing? Like if the labor market softens more and starts to bite even their affluent base, that strategic durability, the resilience of that $895 a year card member, that feels like the real question heading into 2026, especially as we look towards the holiday spending numbers we'll get later in December. How sticky is it really?